Welcome, everyone. Ready to dive into the world of robo-advisors in India? We're going to explore how these algorithms are changing the way we invest.
It's a really exciting area, especially in India. There's so much happening.
Yeah, and for this deep dive, we're looking at a 2024 study from the IIMB Management Review, which is a pretty authoritative source for management insights. And what they found about robo-advisor adoption in India is kind of surprising.
It's definitely a surprise hook for sure. Even with all the hype around robo-advisors globally, they've only reached something like 1.2% of investors in India,
Wow.
which is, you know, incredibly low, especially when you think about how tech-savvy the population is and the huge potential market there.
Yeah, that is really low.
I mean, Statista even projected that the Indian robo-advisory market would reach nearly $45 billion USD by 2026.
So why is the adoption rate so low? That's what we're going to try to figure out today. What's driving this trend and, maybe even more interestingly, what's holding it back?
Right. And we'll also talk about what all of this means for you as an investor. Because even if you haven't thought about using a robo-advisor yet, understanding these trends can help you make better financial decisions down the road.
Yeah, definitely. So first things first, for anyone who's new to all of this, can you give us a quick explanation of what robo-advisors are and how they actually work?
Sure. So basically, they're like digital financial advisors powered by algorithms. You put in information about your financial goals, your risk tolerance, how long you want to invest for, that kind of thing. And the robo-advisor uses all of that to create a personalized investment portfolio just for you.
So it takes the guesswork out of investing, kind of.
Exactly. It's all about automating things and personalizing them. The robo-advisor automatically rebalances your portfolio whenever it needs to, based on how the market's doing and the parameters you set.
And that's where those potential cost savings come in, right?
Right. There was a study by Alile and Ronner back in 2018, and they found that robo-advisors could actually save investors an average of 4.4% per year in fees, compared to if they used traditional human advisors.
That's a lot of money, especially over the long term.
Absolutely. And for someone who's just starting out, it can make investing a whole lot more accessible. They don't have to pay those high fees just to get personalized advice.
So it sounds like robo-advisors have a lot going for them. Convenience, personalization, they could potentially save you money. But they're still having a hard time getting traction in India.
Yeah, that's the paradox we're trying to figure out here. And the IIMB study actually highlights some pretty interesting reasons why.
Okay, let's get into those reasons.
Mm.
The study talks about a few key factors, and they all seem to be connected to, well, the human element of investing, even when you're talking about technology.
Right. I think the first one is trust. It's crucial in any financial decision, but it's even more important when you're basically trusting an algorithm with your money.
I can see why that would be a big hurdle. How do you learn to trust something that isn't human?
Yeah, that's the challenge these robo-advisor companies are facing. The study actually found that 57% of the people they surveyed either didn't really understand how the technology worked or they had worries about data security.
Hmm.
And those things directly affect how much they trust the platform. It's kind of like handing over your car keys without knowing if the person who's going to be driving even has a license.
Right, so it's not just about trusting the technology, it's also about trusting the people behind it and knowing that they're handling your data responsibly. That makes sense.
And then on top of that, you have this general anxiety that some people have about AI in general. The study found that 42% of the participants were actually uncomfortable with the idea of artificial intelligence managing their finances. It's definitely a negative hook. Letting go of control can be unsettling, especially when it comes to your money.
Yeah, that's understandable. We're hearing so much about AI these days, and some of it can be a little intimidating. It's not hard to imagine those anxieties affecting how people feel about their finances.
Yeah, especially for people who didn't grow up with this level of technology.
Exactly. But the study also found that trust and anxiety aren't the only things at play here. Performance expectations are a big deal too. Do investors really believe that these robo-advisors can deliver what they promise?
Right, that's a really important question. And the study found a really strong connection there. The higher the expectation for good returns, the more likely someone was to say they'd use a robo-advisor. 61% of those who thought the performance potential was there were willing to try it out.
So it's not enough to just offer convenience and low costs. You
Yeah.
have to convince people that the technology is going to actually get them results.
Yeah, you have to prove it works. And that's where things get even more interesting, because the study went a step further and looked at how these factors, things like trust, anxiety, and performance expectations, are all influenced by demographics, like age, gender, and how much someone knows about investing.
Right, and that's where we start to see some really interesting differences between generations.
Absolutely. And that's actually where we'll pick up in the next part of our deep dive.